Let's dive right into a fascinating business mystery. We've got this company, right? And on paper, it's a total disaster. I mean, it looks like they're losing money on every single thing they sell. It seems completely doomed. But what if the numbers, the way they were being read, were telling the wrong story?
So let's meet the owner, a guy named Mr. White. He started this new company, M/Hashbag, and he's looking at his very first month in business, and, well, the conclusion he comes to is just devastatingly simple. He's selling these college bags for $50, but it's costing him $65 to make each one. Yeah, you heard that right. That's a clear loss on every single sale. From his perspective, the whole business model is just broken right from the get-go.
And here's the math that got him so worried. Take a look. He sold 400 bags. Great. That brought in $20,000 in revenue. But then you look at his total costs, materials, labor, the factory rent, his salary, and that all adds up to $26,000. Ouch. That leaves him with a pretty painful $6,000 loss in his very first month.
So, yeah, we've got a full-blown business crisis on our hands. The math looks pretty black and white, doesn't it? For Mr. White, this isn't just some small hiccup. It feels like the end of the line before he's even really started.
Think about it. When you believe you're losing $15 on every single bag you sell, what do? Well, Mr. White is seriously thinking about just shutting it all down, closing the factory for good. And honestly, it seems like the only logical move, right? I mean, why would you keep going if every single sale just digs you a deeper hole?
But this is where the story gets really interesting. It's time to dig into what we're calling the profit paradox. Is it really possible that every single sale is a loss? Or is there something else going on here? Something hidden deep inside those numbers?
This right here, this is the number at the absolute heart of the crisis. -$15. It's like the ghost haunting the whole factory screaming, "Stop!" But, and this is a big but, what if that number isn't telling the whole story? What if we've been looking at it completely the wrong way?
And that leads to the big question, is every sale really a loss? This is the exact question a consultant asks, and believe me, it changes everything. It completely challenges the basic assumption Mr. White has been operating on. So let's dig into that.
So a management accountant comes into the picture, and they offer this one crucial clue. The problem isn't the costs themselves. Nope. It's all about how they're being looked at, how they're being categorized and understood.
And you can see that total shift in perspective right here. On the left, you've got Mr. White's view. All the costs are just lumped together in one big, confusing pile. But look at the right. The consultant does something so simple, but it's totally profound. He just splits them into two different buckets: variable costs and fixed costs.
So, what's the difference, right? It's pretty straightforward. Variable costs, think materials, the labor to make a bag, they go up and down with production. The more bags you make, the higher these costs go. Simple. But fixed costs, things like the factory rent or a manager's salary, those stay the exact same every single month. Doesn't matter if you make 1 bag or 1,000 bags. And that right there is the crucial piece of the puzzle. They don't change with volume.
Just by making that one simple change, separating the costs, the consultant suddenly reveals a clear path to actually making money. And that path? It hinges entirely on one single thing: volume.
So if we look at the current situation again, but this time with our new fixed versus variable glasses on, yeah, the loss is still there. At 400 units sold, the money coming in, that revenue, just isn't enough to cover that big, unchanging chunk of fixed costs. The rent and salary.
But then, here comes the game changer. The consultant discovers that the factory isn't even close to its limit. Not even a little bit. It actually has the capacity to produce 1,600 bags a month. That's 4 times what they're doing now. All that potential is just sitting there completely unused. So, with this new info, the consultant does a quick calculation to find the break-even point. And what he finds is amazing. If MS-Hashbag can just sell 700 units, not 1,600, just 700, the revenue they bring in will perfectly cover all their costs, both variable and fixed. Now, at this point, they're not making a profit, but, and this is huge, they're not losing money anymore either.
Now for the magic trick. Remember Mr. White's original goal? To make a $4,000 profit a month? Well, to hit that number, they only need to sell 900 units. Just look at that, A business that was literally on the brink of being shut down for good is suddenly profitable. And they did it without changing the price, without changing the bag, without changing the rent. All they had to do was understand their costs differently and sell more. So this incredible tool, this way of thinking that made the entire turnaround possible, it actually has a name. This is a foundational concept in management accounting, and it's called CVP analysis. CVP analysis. It stands for cost volume profit analysis, and honestly, it's exactly what it sounds like. It's just a framework, a way of looking at things that helps you understand the relationship between three things: what your costs are, how much stuff you sell, and how much profit you ultimately make. It was literally the key that unlocked this entire puzzle for Mr. White. So what's the big takeaway from all this? It really boils down to this simple three-step mindset. Step 1. You have to separate your variable costs from your fixed costs. Always. Step 2. Figure out how many units you need to sell just to break even, just to cover everything. And then, step 3, realize that every single sale you make after you hit that break-even point, that's where your real profit comes from. That's the good stuff.
You know, if you've ever started a business, you know the dream isn't just about making sales, right? It's about actually making a profit. But, where's that line? How do you know when you finally crossed over from just, bringing in cash to actually building something real? Well, that's exactly the question we're going to tackle today.
Yeah, this is the question, isn't it? It's the one that keeps so many entrepreneurs staring at the ceiling at 3 a.m. You're putting in the hours, the sales are coming in, but are you actually profitable yet? It can feel like a total guessing game, but here's the good news. It's not. It's just simple math, and we are going to break it all down.
So to figure this out, we need the right tool for the job. And in this case, that tool is something called cost volume profit analysis. Yeah, I know, CVP sounds kind of corporate, right? But just think of it like a financial GPS for your business. It's going to show you exactly where you are right now, and more importantly, the clearest route to get you to your profit destination.
Okay, so for this GPS to work, we've got to understand the terrain. And in business, the terrain is your costs. They basically fall into two big buckets. First up, you've got your fixed costs. These are the things you have to pay every single month no matter what, whether you sell one item or a million. Think rent, salaries, the stuff that's always there. Then you've got your variable costs. These change directly with every single thing you sell. So like the materials that go into making that one specific product. See? Pretty simple when you break it down.
All right, now that we've got our costs sorted, we can get to the really good stuff. In fact, we can focus on what is probably the single most important idea in this whole explainer. It's a really simple concept, but trust me, it is the absolute engine of profitability, and it's called contribution.
So what the heck is contribution? Well, imagine you sell something. After you've paid for the materials and labor that went into making just that one item, the cash you have left over? That is its contribution. It's the money that each and every sale contributes to paying off all those big fixed bills we just talked about. And the formula? It's so simple. Just your sales price minus your variable costs.
Okay, now listen up, because this part is so important. Contribution is not profit. I'm going to say that again. It is not profit. Not even close. Think of it like a race. Contribution is just clearing the first hurdle. You have to pile up enough contribution from all your sales just to cover your fixed costs. Only after you've done that can you even start thinking about profit.
Okay, enough theory. Theory is great, but let's make this stuff real, right? So for the rest of this, we're going to use a running example. Let's meet Hashbag. It's a company that, well, you can probably guess, makes and sells bags. So every single month, Hashbag is staring up at this giant mountain they have to climb. And that number, that's the size of the mountain, $14,000. That's their fixed costs, their rent, their salaries, all of it. They have to generate enough cash to cover that entire amount before they see a single penny of profit. So how do they do it? How do they climb that mountain? Well, they do it one bag at a time. Let's look at the numbers. Each bag sells for $50. The variable costs, the materials and stuff to make it, are $30, so 50 minus 30, that leaves $20. That's the contribution per bag. So every single bag they sell chips away at that massive $14,000 mountain with just $20. You can already tell this is going to take a lot of bags.
Okay, so now that we get what contribution is, we can finally answer that big question we started with.
Exactly how many bags does Hashbag need to sell just to, well, stop losing money? Let's figure out that magical break-even point. Just imagine the climb for a second. Let's say they sell 10 bags, okay? That's $200 in contribution. I mean, it's a start, I guess, but it's barely a scratch on that $14,000 mountain. All right, let's step it up. What if they hustle and sell 100 bags? Now they're at $2,000. Okay, that's better, but they're still so far from the top. It's pretty clear that just guessing and hoping isn't going to work. We need a formula.
And you know what? There is one, and it's actually super simple. All you have to do is take your total fixed costs, that big mountain of money, and divide it by the contribution you get from one single sale. That's it. That's the formula that gives you your break-even point in units. And there's our number, 700. Hashbag needs to sell exactly 700 bags just to break even. At bag number 700, their profit is exactly zero. All the bills are paid, but they haven't made a dime. But, and this is the exciting part, every single bag they sell after that, bag 701, 702, that's pure profit.
Okay, so knowing you need to sell 700 bags is amazing. That's super useful. But let's be honest, managers, investors, they usually think in bigger numbers. They want to know, what's the revenue target? So how do we figure out the break-even point in total sales dollars? Well, for that, we're going to need another cool little tool.
And this tool, it's kind of like a secret weapon for business managers. It's called the contribution to sales ratio, or just the CS ratio. And all it does is tell you what percentage of every dollar that comes in the door is pure contribution. The good stuff you can use to pay down those fixed costs.
Let's look at how it works for Hashbag. We know that for every $50 bag they sell, they get $20 in contribution. So just do the math. 20 divided by 50, that's 0.4, or 40%. What that means is for every single dollar they make in sales, 40 cents of it is pure contribution that's working to pay off that big mountain of fixed costs.
And because that ratio is always the same for every sale, it gives us this beautiful, elegant shortcut. You just take your total fixed costs and divide it by that CS ratio. That's the whole thing. No more counting up individual bags one by one.
So let's run the numbers for Hashbag. You take their $14,000 in fixed costs, divided by that 40% CS ratio, and what do you get? $35,000. And hey, look at that. That's the exact same break-even point we found before. Remember 700 bags times 50 bucks a pop is 35 grand? We just got to the same answer in one simple step, so much faster.
So you're starting to see how this all clicks together, right? These tools, they aren't just about figuring out where zero is. No, this is the actual blueprint you can use to map out your company's whole financial future. This is how you move from just surviving to actually planning for success.
And this is where that CS ratio becomes a true superpower for planning. Let's say the owners of Hashbag decide they don't just want to break even. They want to make a $4,000 profit this month. Okay. Well, they still have to cover their $14,000 mountain of fixed costs first. So you just add those two numbers together. Their new target, the total amount of contribution they need to generate, is $18,000. So you take that, divide it by their 40% CS ratio, and boom, there's the goal, $45,000 in sales.
And just like that, look what we've done. We went from being lost in the woods, just trying to find our way back to zero, to now having a detailed map that lets us plan a trip to a specific profit destination. You now have the blueprint. You've got the tools to figure out exactly what you need to do to hit your own financial goals.
Because at the end of the day, breaking even, that's just the starting line of the race. The real fun, the real strategy begins when you decide what finish line you're actually aiming for. So let me ask you, what's your finish line?